So equity markets have collapsed because of Wednesday's FOMC meeting and what Jerome Powell had said after. We're going to check out what's going on there. And Swiss yen, not a pair that's spoken about a lot, but something interesting has really happened in it. And there's, a diverging monetary policy regime going on there, which is very, very interesting. And today's trading takeout is going to be on the power of bad takes on social media. We're going to find out more. If you want the very best analysis, education, and insight, then you need to be here every day. So click subscribe now so that you can trade your edge every single day. Well, it's been quite the 24 hours for risk assets. We can see right here sort of what's gone on. Here's where the FOMC meeting was on Wednesday, and there's the resultant fall. It's been pretty brutal and sort of unexpected as well. I certainly didn't expect Powell to come out with what he said. And what he said was, in my view, effectively a 10 basis points hike, even though they didn't hike. They kept rates unchanged. But what he said was that a soft landing isn't their base case, i.e. they expect a recession. And that's why the market's reacted as it has. I think it's off maybe 1.8% from Wednesday's open. If I just pull up the price range, so if we check the open here and go down to there, sorry, it's off even more. It's 2.5%. The last time I looked at it yesterday, it was only 1.8%. So, it's a really, really big decline off of one small statement. And again, this reinforces the fact that, what matters in markets is the level of surprise, is the extent to surprise, because that no hike was priced in for quite a long time now. The market was perceiving no hike since I think about mid-August. And then the ever so slightly softer CPI data ended up reinforcing that fact. Now what we're looking at for November, which was the key meeting for me, and I mentioned yesterday, still is the key meeting depending on what data does, is we're looking at lesser odds even now for a 25 basis points hike in November. Of course, that's going to change. It's quite volatile, that meeting's pricing. So it's a very, very interesting time, but it goes to show the power and the extent to which a central banker can really, really control the direction of the market in the short term without even actually doing anything monetarily. So a small statement of a few words, soft landing is not our base case, is really that powerful. And you might remember, well, I don't know if you would remember, but in 2012, Mario Draghi basically saved the euro by saying, we'll do whatever it takes. And that simple statement, I believe it was in London, he said that, we'll do whatever it takes, basically saved the Eurozone at the time. The narrative was set that the ECB has the back of the market, it has the liquidity backstop for the market. And then we saw the resultant QE and low rates and what we have now. So it's just a matter of fact that central bankers can hike or cut without actually cutting or hiking. So there's something fairly interesting going on with the Swiss franc versus the Japanese yen. And I just want to pull this chart out a little bit further first. So what you may or may not know is the Swiss franc is probably one of the strongest currencies ever right now. It's just been on such a bullish trend for so long, even versus the dollar. And it's quite funny because this is probably averse to what the Swiss National Bank had wanted for quite a long time. However, things seem to be changing. Now, you'll note this high. This high is from 1979, I believe, which is quite insane. And we've just breached that in the last couple of months. So I think it was July that we breached that. July or June. Might have been June, actually. Yeah, June, looks like. And what's very, very interesting now is that there's slight pivoting going on in terms of the monetary policy. So Japan, up at this high, is now looking a little bit hawkish. It's looking to diverge from its long-term monetary policy, which has held for the last 20-odd years, since 1998, after the Asian crisis. So what Japan's been doing is the Bank of Japan has been buying JGBs. And more recently, in the last 7 to 8 years, they've been actually pinning the middle of the yield curve at a certain amount. So they would buy unlimited bonds between 5 and 10 year duration to ensure that the middle of that curve stays at a certain level. I believe it's 0.25% now. But this can be seen as unwinding. And it's not necessarily whether they are going to do it, but the extent of change versus the original baseline that matters. So because Japan has been so dovish for so long, the extent of change from even hinting at hawkishness is big. It's massive. Now, what the Swiss National Bank will be concerned, not necessarily concerned, but being patient over, is that they've tried to get inflation up for quite a long time. Now inflation's ticked up to just over 3%, I believe. They're now pulling back on their hawkish rhetoric. So they paused this week alongside the Bank of England, alongside the Fed, to ensure that they don't overcook the market. And we're sort of seeing that reaction over the last day or two. So if we look on a lower time frame chart, let's get rid of this because it shows it wrongly. We can see that the market dipped by about 200 points. So it went from about 165 down to 163. Pretty big. Now it's done a 100-point rally nearly in a couple of hours, I think overnight, pretty much. So Asia has likely been selling the yen again, probably to get back on that path. I think this might have been a little bit of a reaction. But if you look at the longer term trend, you've got to ask yourself, okay, so we've had all of this monetary policy that has been pretty much in favor of the Swiss franc so far, but now they're pulling back on it. How big is that relative change going to be, especially when you consider the technical structure here? So the relative change is now occurring above a 44-year high. Is it 44 year? Yeah, 1979, 44-year high. So that's quite a big deal to me. This is kind of like a bookmark in a story. Okay, you're revisiting a page to see what happened there because something important happened there. There's no stops up here or anything like that. No one's keeping a 44-year stop. It's got nothing to do with that. It's purely that the market changed up here and what happened back then. Now, I'm not 100% sure on the inflation backdrop back here, but I do know that the 70s was pretty harsh for inflation, right? So what we're probably going to think of here is what similarities can we deduce from this period that caused this trend change, and can a similar trend change occur here in the macro? So is a regime shift going to occur in Swiss yen? It's definitely something to research and think about, and I'll leave you with that to do it yourself. So one thing that I really, really pay attention to is sentiment via social media. And if you've been on social media for a long enough time, you can kind of pick up on who doesn't really know what they're talking about, or at least who doesn't understand how to have a good trade structure. One of the things that I do is note these people down, and it might be, I don't know, a bit of a demerit activity, so a bad activity to do. But at the end of the day, who cares? It's public opinion going out there, and you can try and use as much data as possible to compose your edge and maintain your edge. So that's what I do. So what you should try and look for are these three things. You should look for people who are overly pessimistic. You should look for people who are overly hysterical. But in the main, you should look for people who are overly pessimistic and overly hysterical, who don't actually put a trade structure on within these two mindsets. So they're overly emotional, but they don't actually know how to structure their emotion. Because the next time that they actually put out a trade idea, you can probably hazard a guess that it's going to go the wrong way. They're going to get stopped out, or they're going to make a loss. It's just the way that emotions work, and it's a fantastic tool to use to your advantage.